Hey everyone, it's Tony here, and the Federal Reserve just made a move that changes everything. They didn't just cut interest rates, they took a massive step toward firing up the money printers again. And if you're wondering why your groceries still cost way too much and whether things are about to get better or worse, you need to hear this. I just finished watching the entire Federal Reserve press conference and reading their official statement, so you don't have to wade through all that economic jargon. And what I found is both shocking and, honestly, a little scary for our wallets. So stick with me because by the end of this video, you're going to understand exactly what's coming and what you need to do to protect yourself. Let's start with what everyone expected. The Federal Reserve just cut interest rates by 1/4 point. The Fed funds rate is now sitting at 4.0%. That's the second cut we've seen recently. And honestly, most economists saw this coming from a mile away. But here's what most people missed. And this is the big story. Buried in the official FOMC statement from the Federal Reserve's website, they announced something huge. The committee has decided to conclude the reduction of its aggregate securities holdings on December 1st. Translation? Quantitative tightening is officially over. The era of the Fed pulling money out of the economy just ended. For the last few years, the Fed has been draining their balance sheet, basically deleting money from existence to fight inflation. They've shrunk their holdings by $2.2 trillion. That's trillion with a T. But now, that stops on December 1st. Here's the playbook, and I've been warning about this for months. First, the Fed cuts interest rates. Check. They just did that. Second, they end the tightening cycle. Check. That's happening December 1st. And third, they turn the money printers back on. My estimate, based on historical patterns and where the economy is heading, is that we're looking at trillions of dollars in new money printing, probably starting in 2026. And when that happens, get ready for inflation to come roaring back with a vengeance. How do I know this? Because the Federal Reserve is backed into a corner. They have limited options, and this is the path they always take when the economy starts showing cracks. Now here's where things get really interesting. The next Federal Reserve meeting is December 10th, and everyone's been assuming they'll cut rates again. In fact, before this press conference, there was a 92.8% chance priced in by the markets that we'd see another cut in December. But Fed Chair Jerome Powell threw cold water on that assumption. A reporter asked him point blank, "Is another rate cut in December a done deal?" Powell's response? Not at all. He said there are strongly differing views within the committee about what to do in December. Some members think they've already cut enough. They've moved 150 basis points, and they're now in that neutral range between 3% and 4% where many estimates say they should be. In other words, even the Fed doesn't know what they're doing next month. Here's another wrinkle that could affect the December decision, and this one's wild. Because of the government shutdown, the Fed doesn't have access to the normal labor market data they usually rely on to make decisions. A reporter asked Powell how they're supposed to make policy decisions when they can't see the data. Powell's answer was telling. He said, "What do you do if you're driving in the fog? You slow down." So the Fed might pause rate cuts in December, simply because they literally can't see what's happening in the economy. They said they're going to collect every scrap of data they can find. Private surveys, regional reports, anything to make their decision. But the bottom line is this: uncertainty is high, and when the Fed is uncertain, they tend to be more cautious. Let's talk about the elephant in the room: inflation. Powell was asked directly if the Fed is still committed to their 2% inflation target. His answer? Absolutely. But here's the reality. Inflation is currently running at about 2.8%, and it's been ticking up, not down. And Powell himself admitted that tariff inflation is going to continue into the spring. He expects prices to keep rising by 1/10 here, a couple tenths there, maybe 3 or 4 tenths total before it plateaus. His theory is that tariffs cause a one-time price increase, and then inflation stabilizes at that new higher level. But let me be real with you. That's not how it feels when you're buying groceries or filling up your gas tank. Those one-time price increases add up, and they're permanent. Powell actually said something that I think is really important. He acknowledged that people are unhappy about inflation, and he explained why. It's not just current price increases. It's the cumulative effect of the massive inflation we saw in 2021, 2022, and 2023. Sure, the rate of price increases has slowed down, but prices are still way higher than they were a few years ago. Your rent, your groceries, your insurance, all of it is more expensive, and it's staying that way. Powell said it'll take time for people to feel better as their incomes catch up to these higher prices. But here's my question. How long is that going to take? And what happens if the Fed starts printing trillions of dollars before incomes catch up? That's just going to make things worse. Okay, so when does the actual money printing start? Powell said they're entering a new phase. First, they stop shrinking the balance sheet on December 1st. Then, they're going to hold steady for a time while they monitor what's happening in the economy. But here's the thing. Powell kept that timeline deliberately vague. And I think I know why. They're waiting for something to break. A financial crisis, a banking problem, a recession, something that gives them the justification to jump in with massive money printing to save the economy. That's always how it works. The Fed waits for a crisis, then they print money to fix it, and we all pay for it through inflation. The Fed's balance sheet peaked at 35% of GDP. They've brought it down to 21%. But mark my words, when they start printing again, it's going to go right back up, and probably higher than before. All right, let's get practical. Here's what you need to do to prepare. First, if you have debt, especially variable rate debt, understand that rates might not keep going down. The Fed is uncertain, and if they pause cuts or inflation picks back up, your borrowing costs could stay elevated. Consider locking in fixed rates where you can. Second, build that emergency fund. I know it's tough, but even $300 minus $500 set aside can save you when unexpected expenses hit. If the Fed starts printing money and inflation accelerates again, you'll be glad you have a cash cushion. Third, think about where your money is going. If inflation is heading back up, cash loses value over time. I'm not giving investment advice, but educate yourself about assets that historically hold value during inflationary periods. Fourth, focus on increasing your income. That's your best inflation hedge. Whether it's negotiating a raise, learning a new skill, or starting a side hustle, your earning power is what matters most. Fifth, track your spending and cut where you can. I know you're probably already doing this, but if we're facing another wave of inflation in 2026, every dollar you save now gives you more breathing room later. Look, here's the reality. The Federal Reserve just signaled that the era of tight money is over. They're pivoting toward easier money and eventually toward full-blown money printing again. For people like us living paycheck to paycheck, this has serious implications. Lower interest rates might help with borrowing costs in the short term, but if it leads to another surge in inflation like I think it will, we're going to get hit the hardest. The wealthy will be fine. They always are. They own assets that go up when the Fed prints money. But for working families trying to afford rent, groceries, and gas, we're the ones who suffer when money printing drives prices higher. I'm not saying this to scare you, I'm saying it so you can prepare. Knowledge is power, and understanding what the Fed is doing gives you time to adjust your strategy. I want you to know that you're not alone in feeling frustrated or worried about all this. The Fed's policies affect all of us, but they hit low and middle-income families the hardest. That's not fair, but it's the reality. What we can do is stay informed, make smart decisions with the information we have, and support each other. That's why I make these videos, to break down what's really happening so you can make the best choices for your family. You've got this. We're going to navigate this together. If this video helped you understand what the Federal Reserve is really doing and why it matters for your wallet, please hit that subscribe button. I'm going to keep you updated every step of the way as this situation develops. The December meeting is going to be huge, and I'll break it down as soon as it happens. Also, check out my other videos on surviving inflation and managing money when you're already stretched thin. Real strategies that actually work for real people. Drop a comment and let me know. Are you worried about another wave of inflation? Do you think the Fed is making the right moves? I read every single comment and I want to hear what you're thinking. Thanks for watching, and I'll see you in the next video. Stay informed, stay prepared, and take care of yourself and your money.